Welcome, candidates, to this Masterclass Explainer. I'm your principal examiner, and today we're doing something a little different. I am going to guide you step by step on exactly how to secure that highly coveted A-star grade when it comes to the disposal of non-current assets. We're going to peel back the curtain. I'll be showing you exactly how a strict examiner, like me, grades your work, where you're currently throwing away incredibly easy marks, and how to elevate your financial analysis to the absolute highest level. Look, if you think this topic is just some basic record-keeping exercise, just blindly writing numbers in little boxes and drawing straight lines, well, you've already lost marks. Actually, scratch that. You've lost the entire plot. This module is the fundamental bridge to high-level financial intelligence. You absolutely must demonstrate to me that you understand the duality of every single transaction and how it actively impacts the underlying business entity. It's a living, breathing thing. So, to guarantee those maximum marks, we are going to strictly follow this agenda today. We'll start with core concepts for top grades, move into flawless technical execution steps, then compare T accounts versus modern AI. After that, we'll dive into interpreting ratios and profitability, and finish up by looking at how to avoid strict exam traps. Okay, let's jump right into Section 1, Core Concepts for Top Grades. We need to establish some absolute non-negotiable rules right off the bat. First up, terminology. The syllabus has completely transitioned to modern international terminology, and you have to keep up. You must use specific phrasing, like irrecoverable debts for a debt that simply cannot be collected, and owner's equity with literally 100% accuracy. If you're still using outdated terminology in your answers, my red pen is coming out and I will dock points. You've got to use the correct vocabulary, all while maintaining that fundamental accounting equation, assets equal liabilities plus equity, at all times during the fiscal period. No exceptions. Now here's where it gets really interesting. During an asset's disposal, there's this massive tension, like a giant tug-of-war, between two fundamental accounting concepts. On the left side, you've got the historical cost principle, which dictates we record assets at their original purchase price, right? But on the other side, pulling just as hard, is the prudence concept. This dictates we absolutely never anticipate profits and we always provide for losses. So if you just ignore potential losses during a disposal, say an asset loses value way faster than you anticipated, you are violating the prudence concept. You're basically overstating your profits, and I promise you, I will heavily penalize you for that. Moving right along to Section 2, Flawless Technical Execution Steps. Let's see how those core concepts actually translate into the mechanical steps you need to take. Think of this procedural flow like a chain reaction. You must follow it strictly. Step 1, identify the correct source document. Is it an invoice, a credit note, a bank statement? That specific document then feeds into Step 2, your books of prime entry. From there, you build your T accounts, which culminates in Step 4, a perfectly balanced, accurate trial balance. If you skip even one single step here, your entire double entry system breaks down, and your final financial statements are going to be entirely invalid. Now listen to me very, very carefully here, candidates, because this is the ultimate A-star secret. Earning method marks can literally save your grade. In that high-pressure exam room, even if your final math completely fails, I will still award you crucial method marks if you clearly show your workings. If you can demonstrate a logical, step-by-step procedural flow for complex adjustments, like depreciation, inventory valuation, or error correction, you are going to salvage points. Let me be clear, an incorrect final balance with perfect workings is always better than a correct final balance with absolutely no visible methodology. Show your work. All right, Section 3, T accounts versus modern AI. Let's briefly step out of the exam room and contrast these strict requirements with what's actually happening out there in the real world of finance. The contrast is honestly brilliant. Out in the wild, modern AI-driven fintech software, like Xero, handles these automated asset disposal flows in a fraction of a second. The AI calculates the depreciation, records the realization, and perfectly updates the ledger without breaking a sweat. But, and this is a big but, your reality in the exam room requires pure manual mastery. You have to meticulously construct the T account gold standard by hand. You've got to distinguish perfectly between a balance brought down and a balance carried down. In that exam hall, you are the AI algorithm. Let's move to Section 4, Interpreting Ratios and Profitability. Because just calculating the numbers is how you pass. But interpreting and evaluating them, that's how you get the A-star.
Imagine you're looking at a business, and their liquidity ratio suddenly drops from 2.5 to 1 down to a risky 1.1 to 1. Any human calculator can just state the math, but an A-star candidate, they interpret it. You have to ask yourself, well, why did this happen? Did the business just go on a massive shopping spree and overpurchase inventory? Are they settling their trade payables way too slowly? Or are their cash reserves just totally depleted because they made a massive capital expenditure, like buying a huge new non-current asset? That is the high-level financial intelligence I'm looking for when I'm grading your papers.
You also have to master inter-firm comparisons, which can be super tricky. Different firms use completely different accounting policies. Company A might use the straight line method for depreciation, while their biggest competitor uses the reducing balance method. Because of that difference, doing a direct comparison is basically like comparing apples and oranges. It's incredibly difficult. You're expected to dig deeper, look past those surface numbers, and analyze the true quality of the reported profit. You have to evaluate how those differing depreciation choices are directly impacting the company's long-term return on capital employed, or ROCE.
And hey, while you're buried deep in all those calculations, please don't forget the invisible elements. Things like staff morale, the physical business location, and their overall market reputation. These are absolutely crucial non-financial factors. They aren't captured anywhere in a T account, but they are vital for assessing if a business is actually sustainable long-term. Think about it. A company could have a flawless trial balance on paper, but if their staff morale is rock bottom and their market reputation is completely ruined, those numbers are meaningless for the future. You absolutely must mention these factors in your evaluation answers.
Finally, we reach Section 5, Avoiding Strict Exam Traps. I am opening up my personal examiner's red pen playbook here to show you exactly where capable students completely threw away top marks recently. Please take note of these specific warnings from the 2024 and 2025 exam cycles. I have seen way too many brilliant students lose incredibly easy marks for the most frustrating reason: poor, completely illegible handwriting in their ledger accounts. Look, if I literally cannot read your balance brought down, I simply cannot award you the mark. It's that simple. Secondly, a catastrophic failure to separate revenue expenditure from capital expenditure is going to entirely skew your profit calculations. Don't do it. Also, be super careful not to miscalculate percentages when you're dealing with trade versus cash discounts. And lastly, always remember your state symbols in manufacturing accounts. These are unforced errors, guys. Don't make them. So, how do you actually avoid these traps when the clock is ticking and the pressure is on? Memorize this simple mnemonic: DPTT. Document, prime entry, T account, trial balance. When you're in the middle of a brutally complex asset disposal calculation and your brain suddenly freezes, just stop. Write DPTT on your scratch paper. It will instantly reorient you. It ensures your procedural flow stays perfectly intact and grounds you right back into the logical framework that guarantees you those critical method marks. As we wrap up this explainer and you finalize your preparations for this rigorous exam, I want you to ask yourself a very serious question. Are you just functioning as a human calculator, blindly memorizing how to balance the books? Or are you ready to step up and demonstrate the high-level, analytical financial intelligence that absolutely demands an A-star grade? Master the terminology, respect that prudence concept, show me your workings, and interpret the true story behind the numbers. Best of luck, candidates. You've got this.